Now, you do have quite a nice presence on the product side. What are you seeing in that market?
Well, the products market at the moment is, I would say, not so much in a recession as a depression. Rates are, no matter what you look at, whether you look at in the Atlantic Basin TC2, TC14, or even in the East TC12, these rates are almost at an all-time low. Certainly from 2011, which is when we, before that we don't pay too much attention to it. The rates are extremely low, lower than we've ever seen, and the earnings are at the very low end of normal, only because bunker prices are low as well. But we are back to the bad old days of 2012, 2013.
Does this not spell opportunity for a company such as yours?
Well, I think it does, but we've got, essentially, if you think about what happened from last year, we had very high freight rates, as you recall. And we think the reason for that was, there was a number of reasons for it. One was that we had a big increase in refinery runs worldwide. There was about 1.7 million barrels a day of extra processing being done, particularly in east of Suez, with the new Middle Eastern refineries coming on. And west of Suez, of course, we had the Gulf Coast refineries with increased runs as well. You couple that with very high refinery margins, so for the first time in a long time, the European refineries were running flat out, and so exporting a lot of product. So we had a lot of product moving around in the Atlantic Basin. We also had some refinery problems on the west coast of the US, and so that was causing product to be imported, which tend to be long journeys. And despite that, on the other side, from a supply perspective, although the fleet was growing, particularly I'm talking about MRs particularly, we added, 90, 100 MRs last year. Most of those stayed in the East. So as we were in last year, looking year on year or comparing 2015 to 2014, we weren't noticing an increase in the number of MRs operating in the Atlantic Basin because they're all in the East where the new Middle East refineries are running, and there was a lot going on there. So that was really supportive for the Atlantic Basin, and we saw very, very high freight rates. Now, of course, what's happened since then is that the refinery margins have come off somewhat. So year on year, 2015 into 2016, we've got reduced runs west of Suez, particularly in Europe. We've still got increased runs in the east year on year, and we don't have the problems in the in West Coast US. And also Latin America was pulling a lot of products as well, I should have added, because they had some lower refinery runs generally in Latin America. Now, meanwhile, the fleet has migrated back into the Atlantic Basin, and so fairly recently we were looking at an aggregate number of MRs in the Atlantic Basin compared to this time last year of about 80 higher. So we had last year, if you like, was a perfect storm, which helped freight rates be really, really strong. This year it's the complete opposite, and we've got now too many ships in the Atlantic Basin, and rates are under pressure. And now, yes, it's an opportunity, but unfortunately the fleet isn't stopping growing yet. We've still got more deliveries to come this year. We've got more deliveries next year. The big macro moves are done. We're not really expecting any major increases in refinery throughputs now as we go into next year. So it's hard to see how freight rates recover substantially in the short term while we overcome the surplus of capacity which has been built up. It's really tricky to know how long it will take for that to turn, to find an inflection point where the market gets back into balance. But that's certainly into next year, we feel. At the moment, they're very depressed, and below OPEX on almost everything. So it's a miserable time for ship owners, and we suspect it will stay miserable, for some time to come. Although maybe not quite as bad as it is now. But in terms of the opportunity, it is still a case of trying to spot where that inflection point is, and it's not immediately obvious to us how far away or how close that is. But we don't feel it's that close.
The implication behind your answer is that there are going to be some casualties sooner or later.
Yeah, we've seen, as you know, casualties in the dry market. The dry market, they've been operating below OPEX for, longer than one would have thought possible or probable. We're now for the first time in a long time in the products market where ships are operating below OPEX. And to us, it seems inevitable that there will be some casualties or people needing to sell ships one way or the other. You've obviously got some of the banks trying to refinance or move their shipping portfolios, their shipping debt portfolios on. So we think there probably has to be some rationalisation in the tanker market as well. Although certainly the tanker market is much more consolidated than the dry bulk market, where it's still pretty fragmented and there's a lot of work to be done there. The tanker market is more consolidated, but it's hard to see if freight rates stay where they are for another year. Hopefully it won't be that long, but if they do, it would be hard to think there won't be casualties somewhere along the line.
You mentioned banks effectively trying to kick the problem further down the road or move things on. Are we seeing the new sources of funding that entered the market post the 2008 crash losing patience, perhaps also looking to move things on?
So you're talking about sort of private equity and the non-traditional players. Well, I think obviously there's the private equity won't be particularly happy with the way things are going at the moment, but they're probably have the pockets to be patient and to ride through this wave for however long it lasts. So I think it's unlikely that you're going to find sort of new private equity looking to come in just at the moment, and obviously getting debt will be more difficult because the banks are uncomfortable with what they have and trying to get rid of it. So financing ships will get more difficult, but I don't think necessarily you're going to see them moving out. So I think they'll just have to sit with it and ride the cycle, and somewhere down the road this will turn and the markets will recalibrate and rebalance, and they certainly have the pockets to be able to do that.
There are some big regulatory decisions in the offing which could have quite profound implications for trade routes and supply and demand in the product sector. How do you think they'll play out?
So start with the sulfur fuel content. I mean, that's a major cost burden for the industry. It's a cost burden for the ship owner because they'll have to pay much more for their fuel than they are now. It's a major cost burden for the refineries because there'll be a lot of refineries that won't be able to meet the new spec. So I think at the moment in a market where ships are long and the supply-demand balance is imbalanced to the supply side, anything which increases cost to the ship owner will result in lower earnings for the ship owner. So I think if it's 2020 is still a number of years away, and a lot can happen between now and then, but a lot will need to happen between now and then for the industry, the shipping industry, and the refining industry to get ready for that.
We, of course, met at the SPNL event in London. What for you were the key talking points from that debate?
We were focused on the product market. I think the interesting thing for us, we look at this market whilst we have MRs, and so we feel the rate pressure at the moment. We look at the market very analytically, and so we'll take what we'd like to think is a dispassionate view about the market, which is not massively optimistic at the moment. Ship owners do tend to be born from massively optimistic bloodlines, and as we saw, in the slightest sort of kick up in rates, and people will order new ships in a drop of a hat. And to us, it's astounding that even in the dry freight market, which has been frankly a dog, that there's still new ships tipping out the yard. I mean, how people decide to do this, I don't know. It's not something we could ever figure out. So I think it's good that people are optimistic, but it doesn't help solve the perennial oversupply in the shipping market.
There's oversupply, particularly on the product side. As you say, you take a dispassionate look at things. You have a widened remit under the terms of the new ownership. Can we see you entering into new segments in the near future?
I think never say never. We're quite interested in the dry freight market at the moment. That's been depressed for so long, and there's some consolidation going on, that there's an inflection point coming there, which we think probably is sooner rather than later. And maybe the inflection point on dry, possibly we reach it sooner than tankers. But for us, it will always be just a hard clinical view of the economics of owning or operating a ship, where be that in the product sector, crude or dry freight. And it's only if we can make the economics work by looking at the forward curve rather than a projection of what earnings may be, that we'll make investments. But certainly, if the opportunities presented themselves, we'd certainly be looking at other entrees into the shipping market.
As you say, you also look into the movement of oil around the place. As we speak, there are discussions going on amongst the major oil producers about a potential freeze. Any thoughts around that and how that might impact?
Well, I think there's two things. One is that bunker prices, of course, are a massive component on earnings. And last year, we had the bunker prices were falling as the price of oil was falling, and freight rates weren't going down. So the earnings were increasing. In fact, freight rates were going up. So it was a double positive whammy for ship owners. This year, of course, we've had a rally from the lows. At the low, I think bunker fuel or high sulfur got to about $130 a ton. It's now about $240 a ton. The risk, I think, for the ship owning community is that because the market is an oversupply, if the price of bunkers go up, we don't believe that freight rates will go up to compensate owners for that. That will just eat into earnings. And so for us, every $10 increase in bunker price takes about $200 a day of earnings, roughly, off an MR. So the real danger for the shipping industry as a whole is if there was some agreement which went beyond what may be expected, and we had a $10 rally in oil prices. That I think that would be really even worse news for ship owners than it is now. Now, the agreement itself, Saudi offering to cut for an Iranian freeze. Saudi production tends to decrease as we go into the end of the year anyway, because they reduce the oil they consume for burning. And it's not quite clear what Iran would get from freezing, having just come out of a long period of isolation. So we'll see. Finally,
John, if you invite me back and we sit here in 12 months' time, what do you think the key talking points will be?
I think it will always be about freight rates and earnings. But of course, the thing which will happen almost exactly 12 months to the day is the advent of the ballast water treatment. From the 8th of September of next year, if a ship owner hasn't done a special survey or dry docking, the next subsequent dry docking, they'll be required to fit ballast water treatment. Now, that's an expensive piece of kit. As you know, US Coast Guard hasn't even ratified any systems yet. But even if you allow for the cost of acquiring it, fitting it, and the off-hire time, we're talking maybe $500,000, $1 million a ship on an MR. And this is going to be another hammer blow for the shipping industry. Unless freight rates have sort of recovered rapidly, meanwhile, to give everybody a bit of a cushion, I think that's going to be a hammer blow for the industry, and it's likely to cause another ratchet down in asset prices, as owners who don't have the financial strength to or desire to spend $1 million a ship to fit ballast water will be obliged to or want to sell and move on.
Have you made the ballast water system choices for your fleet of vessels?
We have 5 ships which are on bareboat charter, so we're disposant owners and thus liable for fitting equipment like that as it becomes into force. Fortuitously, 3 of them have just undergone a dry docking. The third is just going into dry dock as we speak now, and the other 2 we expect to be in dry dock next year ahead of 2017. So we'll have a little bit more time to think about that problem.
So much like freight rate and earnings, it comes down to timing.
Absolutely.